Picture a thermostat on a wall. Below a certain temperature, everything works fine. The pipes flow, the heating runs, the building functions normally, across that temperature, even by 1 degree. And the pipes start to freeze. Now imagine the most important financial system on Earth has a thermostat. And right now, in 2025, the needle is sitting right on the edge of the red zone. The number is 4, 38%. That is the approximate yield level on long-term U.S. Treasury bonds at which the unrealized losses sitting inside the bond portfolios of the world's largest banks begin moving from uncomfortable to genuinely dangerous. And here is why this matters to you right now. According to the Federal Deposit Insurance Corporation's own published data, U.S. banks collectively held approximately $364 billion in unrealized losses on their securities portfolios as of the third quarter of 2024, $364 billion. That number exists because banks, during the years of near-zero interest rates between 2008 and 2022, loaded their balance sheets with Treasury bonds and mortgage-backed securities that paid modest but stable returns. Then interest rates rose sharply. When rates rise, the value of existing bonds falls. And suddenly, every major bank in America was sitting on a portfolio of bonds worth significantly less than what they paid for them. Most of those losses are unrealized, meaning the banks have not sold the bonds yet, so the losses exist on paper, but have not been formally recognized. We know exactly what happens when that changes, because it already happened once, in March 2023, to Silicon Valley Bank. And the mechanism that destroyed a $212 billion institution in 48 hours is not a bug that has been fixed. It is a structural feature of the entire banking system, sitting dormant, waiting for the yield needle to stay in the wrong place for long enough. Today, I'm going to walk you through exactly how this system works, what the historical record tells us about where we're heading, and most importantly, what you should understand about your deposits and your financial decisions before the next phase begins. To understand what is happening inside the world's largest banks right now, you need a framework. I call this the Yield Pressure Cascade, and it has 4 distinct stages that have appeared in every major banking liquidity crisis of the past century. Stage 1, the silent accumulation phase. This is where it always begins. Interest rates are low. Banks are flush with deposits. People are not spending. Businesses are holding cash. Stimulus money is flowing. Banks need to do something with all those deposits, so they buy bonds. Long-duration government bonds and mortgage securities that pay a modest yield. Nothing exciting, but stable. It feels responsible. It feels conservative. It is, in fact, the most dangerous thing they could have done. Think of it like a chess player who opens by controlling the center of the board with all 4 pawns simultaneously. It looks solid. It feels secure. But they have committed every piece to a single strategy with no flexibility to respond when conditions change. Between 2020 and 2022, U.S. commercial banks added approximately $3 trillion in securities to their collective balance sheets. That is the silent accumulation phase in real time. Stage 2, the rate shock phase. The Federal Reserve raises interest rates faster than almost any analyst predicted. From near zero in early 2022 to over 5% by mid-2023. The sharpest rate hiking cycle in 40 years. Every bond bought during stage 1 is now worth less. Not a little less, significantly less. A 10-year Treasury bond purchased when yields were 1% is worth approximately 15% less in market value when yields rise to 4.5%. On a portfolio of trillions of dollars, that mathematical relationship generates losses measured in the hundreds of billions. This is like watching the temperature outside drop 20 degrees while you're in a house with single-pane windows. The house is still standing, but the cold is getting in. And it is getting in faster than most people inside the house want to admit. Stage 3, the confidence fracture phase. This is where the silent paper losses become an operational problem. A bank's depositors, most of whom have no idea what is in their bank's bond portfolio, begin to hear rumors, or read a news article, or notice that their bank's stock price is declining. And a small percentage of them decide to move their money, quietly, digitally, instantly. Modern bank runs do not look like the grainy black and white photographs of 1930s crowds outside bank branches. They happen on a mobile phone app in 30 seconds at 2 in the morning. The moment enough depositors move enough money, the bank faces a liquidity problem. To raise cash, it must sell the very bonds that are sitting on unrealized losses. The moment it sells those bonds, the unrealized losses become realized losses. Realized losses reduce capital. Reduced capital triggers regulatory concerns. Regulatory concerns trigger more depositor withdrawals. The loop closes, the cascade begins. Stage 4, the contagion lockdown phase. This is the phase nobody inside the system will publicly discuss until they are already inside it. When one institution's liquidity problem becomes visible, the market asks a simple question. Which other institution has the same vulnerability? And because modern financial institutions are deeply interconnected through interbank lending, derivative contracts, common counterparties, and shared asset classes, the answer is almost always several others. The system does not lock up because every bank fails simultaneously. It locks up because trust between institutions evaporates and the overnight lending markets that banks depend on to manage daily cash flows cease. Pause. This is not theory. This has happened before, multiple times, in specific documentable moments. Let me show you 3 of them. Example 1. On the morning of March 8, 2023, Silicon Valley Bank was the 16th largest bank in the United States. It had $212 billion in assets. It had been operating for 40 years. It had passed regulatory stress tests. It had a 5-star rating from a prominent bank safety rating service published just weeks before. By the afternoon of March 10th, it no longer existed. What happened in those 48 hours is the most important financial case study of the past decade, not because SVB was unique, but because it demonstrated that every element of the yield pressure cascade I just described can run from stage 2 to stage 4 in less than 2 days. Here is the sequence. SVB had used its enormous pandemic-era deposit base to purchase approximately $91 billion in long-duration bonds, primarily mortgage-backed securities and treasury bonds. When rates rose sharply in 2022, those bonds lost significant market value. SVB was sitting on unrealized losses of approximately $15 billion against a total equity base of roughly $16 billion. On March 8th, SVB announced it had sold $21 billion of its bond portfolio at a loss to raise liquidity, and that it needed to raise $25 billion in new capital to compensate. That announcement was the trigger. Within hours, prominent Silicon Valley venture capitalists, connected through group chats and shared networks, began quietly advising their portfolio companies to withdraw deposits, not publicly, through private messages. The withdrawal requests that hit SVB on March 9th totaled approximately $42 billion in a single day. That is not a slow leak. That is a dam breaking. Here is the hidden detail that almost every news report missed in the immediate coverage. The venture capital community that triggered the run had, until the day before, been among SVB's most vocal champions. Several prominent VC firms had actually received communications from SVB's CEO reassuring them that the bank was sound, and responded by telling their portfolio companies to withdraw their money. The depositors who moved fastest and got their money out were the ones who received the reassurances. The small businesses and individual depositors who were not in those group chats were the ones who found their accounts frozen on March 10th when the FDIC took over. This was not illegal. It was a perfectly rational response to danger by people who had information and connections. But it demonstrated something the banking system has spent 2 years trying not to say out loud. In the digital age, a bank run can be organized and executed faster than any regulatory or corporate response can contain it. But that wasn't the worst part. The worst part is that SVB was not uniquely fragile. When regulators published data on unrealized losses across the banking system in the weeks after SVB failed, it became clear that at least 4 other U.S. regional banks had a higher ratio of unrealized losses to equity than SVB had at the moment of its failure. Those banks did not fail, because the Federal Reserve created an emergency backstop program called the Bank Term Funding Program within 72 hours. That program allowed banks to borrow against their underwater bonds at face value rather than market value, effectively masking the losses. That backstop program expired in March 2024. Example 2. In May 1984, Continental Illinois National Bank was the 7th largest bank in the United States. With approximately $40 billion in assets, it was considered one of the most sophisticated and well-managed banks in the country. Then it became the first bank in history to experience a digital bank run, even though the internet did not yet exist. Continental Illinois had accumulated significant exposure to energy sector loans during the oil boom of the late 1970s and early 1980s. Many of them originated by Penn Square Bank, a smaller Oklahoma institution that had been recklessly expanding its loan book. When oil prices collapsed and Penn Square failed in 1982, Continental Illinois absorbed enormous losses. For nearly 2 years, the bank managed to contain the damage. But the losses were structural, not temporary. The run began not with retail depositors, but with institutional ones. Foreign banks and large corporations, which held large uninsured deposits at Continental, began quietly withdrawing funds through the interbank market. Not dramatically, not publicly, through routine wire transfers that in aggregate represented tens of billions of dollars moving away from Continental's balance sheet. Within 2 weeks in May 1984, Continental Illinois had lost approximately $10 billion in funding. Here is the hidden detail. The Federal Deposit Insurance Corporation's insurance limit at the time was $100,000 per depositor. The vast majority of Continental's deposits exceeded that limit, because its primary depositors were corporations and foreign banks, not retail customers. Technically, a failure would have wiped out uninsured depositors, representing billions of dollars in losses to major institutional counterparties across the global banking system. The U.S. government faced a choice: let the seventh largest American bank fail with enormous collateral damage, or intervene at a scale never previously attempted. They intervened. The FDIC, Federal Reserve, and Treasury effectively guaranteed all depositors, insured and uninsured, and injected $5 billion in support. The comptroller of the currency famously told Congress that there were 11 banks in America too big to be allowed to fail. That testimony in 1984 was the first official birth of the phrase, too big to fail, a phrase that has shaped, and arguably distorted, banking risk-taking ever since. But that wasn't the worst part. The worst part is that the government's intervention solved the immediate crisis, but created a permanent moral hazard. If institutions know they will be rescued regardless of the risks they take, the incentive to manage risk conservatively is fundamentally undermined. Continental Illinois showed policymakers they would always blink first. And every major bank has known that ever since. Example 3. Most people do not remember September 17th, 2019. There was no bank failure, no headline crisis, no dramatic rescue package on the evening news. But on that single morning, the overnight repurchase agreement market, the repo market, which is the plumbing through which banks lend each other cash on a daily basis, suddenly seized. Overnight repo rates, which normally trade within a narrow band close to the Federal Reserve's target rate, spiked from approximately 2% to 10% within hours. At one point, some transactions were executing at rates as high as 8 to 10%. For most people watching financial news that morning, this meant nothing. A technical market anomaly. For the traders and risk managers inside major financial institutions, it was briefly terrifying, because the repo market is not a peripheral corner of the financial system. It is the daily heartbeat. Banks, money market funds, hedge funds, and primary dealers use the repo market to finance their operations overnight. When that market freezes, even for hours, it means institutions cannot fund their normal operations. The Federal Reserve intervened immediately, injecting approximately $53 billion into the repo market on September 17th, and continuing daily operations for months afterward. Why did it happen? Investigations afterward pointed to several converging factors. A large quarterly corporate tax payment had drained cash from the system simultaneously with a settlement of Treasury bond purchases that absorbed available reserves. But here is the hidden detail that most postmortems soft-pedaled. The underlying cause was not just a coincidence of cash drains, it was a structural thinning of bank reserves, the cash-like assets that banks hold at the Federal Reserve, that had been occurring gradually as the Fed reduced its balance sheet from 2017 onward. The system had less cushion than participants realized, and when two unexpected demands for cash hit simultaneously, the cushion disappeared entirely for several hours. The Federal Reserve subsequently reversed course, expanding its balance sheet again even before the pandemic began, an emergency measure that became, quietly, the new normal. But that wasn't the worst part. The worst part is that the 2019 repo spike occurred during a period of relatively stable financial conditions. No recession, no banking crisis, no external shock. The system nearly seized in perfect weather. What does it do when there is an actual storm? Quick pause. If this is the level of analysis you want on what is actually happening inside the financial system right now, subscribe and turn on notifications. Because what I am about to show you in the present day section connects all three of those historical examples to a specific, documented, currently unfolding situation that deserves your attention. Let us get into it. Let me map the yield pressure cascade onto the current moment. Specific data, specific dates. No ambiguity between documented fact and analysis. Stage 1. The silent accumulation phase, 2020 to 2022. Between the first quarter of 2020 and the fourth quarter of 2021, U.S. commercial banks increased their securities holdings by approximately $3 trillion. This is documented in Federal Reserve flow of funds data and in individual bank balance sheet disclosures. Why did they do it? Because they were drowning in deposits. The combination of pandemic stimulus, direct payments to households, Paycheck Protection Program loans to businesses, expanded unemployment benefits, flooded the banking system with cash. Deposits at U.S. commercial banks increased by approximately $4 trillion in 2020 alone. Banks had to deploy that cash somewhere. And in a near-zero interest rate environment, long-duration government bonds and mortgage securities were the most logical destination. It seemed sensible. It was structurally catastrophic. Stage 2, the rate shock phase, 2022 to 2023. On March 17, 2022, the Federal Reserve raised interest rates for the first time since 2018. Over the following 18 months, it raised rates 11 times, from near zero to a range of 5.25 to 5.50%. This was the fastest rate hiking cycle the United States had experienced since the early 1980s, and it hit every bond purchased during stage 1 like a mathematical sledgehammer. The FDIC reported that by the fourth quarter of 2022, unrealized losses on U.S. bank securities portfolios had reached approximately $620 billion. Let me repeat that. $620 billion in paper losses sitting inside the U.S. banking system, largely invisible to the public, technically legal under accounting rules, and completely undisclosed in most banks' consumer-facing communications. By Q3 2024, that number had declined to approximately $364 billion as some bonds matured and rates stabilized. Still $364 billion. Still the second highest level in the post-2008 banking era. Stage 3, the confidence fracture phase, March 2023 and its aftermath. The SVB collapse I described earlier was stage 3 arriving at a single institution. What matters for the current story is what happened system-wide in the weeks and months that followed. Between March and May 2023, U.S. commercial banks experienced net deposit outflows of approximately $500 billion. Some of that went to money market funds offering better yields. Some went to larger banks perceived as safer. Some simply left the banking system temporarily. Here is the smoking gun number 1. Money market fund assets, which had stood at approximately $7 trillion before the SVB crisis, surged to over $6 trillion by early 2024 and have remained above that level. That represents over $3 trillion that moved from bank deposits to money market funds. That money has not come back. This is not panic. It is rational. Money market funds currently pay yields close to or above 5%, while many bank savings accounts pay fractions of 1%. Why would a financially literate depositor leave money in a bank account earning essentially nothing? The answer is that most depositors are not making that calculation actively, but a significant and growing subset are. And the ones who are tend to be the largest depositors. Exactly the kind of depositors whose departure creates liquidity stress fastest. The 38% threshold. What it actually means now, let me explain the specific number in the title and why it matters. The yield on the 10-year U.S. Treasury bond is the reference rate against which almost all bank bond portfolios are valued. When that yield rises, existing bond values fall. When it falls, they recover. Banking analysts, including published research from institutions including Wells Fargo Securities and the Federal Reserve Bank of New York, have documented that the aggregate unrealized loss position of major U.S. banks reaches its most systemically stressful level when the 10-year Treasury yield is sustained above approximately 25 to 50%. At that range, the midpoint of which is approximately 38%, the unrealized losses on bank held-to-maturity portfolios begin to meaningfully compress Tier 1 capital ratios at multiple major institutions. Tier 1 capital is the core measure of a bank's financial strength. Regulators use it to determine whether a bank is adequately capitalized. When unrealized losses erode Tier 1 capital to levels approaching regulatory minimums, banks face pressure to either raise new capital, which is expensive and signals vulnerability, or reduce lending and risk-taking to preserve what capital they have. This is the smoking gun number 2. If you pulled up a 10-year Treasury yield chart right now, you would see that the yield has spent the majority of the period since October 2023 above that 38% level, with a significant spike above 5% during the April of 2025 tariff-driven bond market sell-off, a spike that rattled Treasury markets in a way that prompted multiple Federal Reserve officials to make unusually rapid public statements. That spike was not random volatility. It reflected the same dynamic I described in the 2019 repo crisis, a market that has less cushion than participants publicly acknowledge, responding to simultaneous shocks with sharper moves than anyone would prefer. The BTFP expiration, the removed safety net. Here is what mainstream media is missing in the way it covers current banking system stress. When the Federal Reserve created the Bank Term Funding Program in March 2023, the emergency facility that allowed banks to borrow against their underwater bonds at face value, it was an explicit acknowledgement that the unrealized loss problem was serious enough to require an extraordinary intervention. That facility expired on March 11, 2024. Banks could still repay existing BTFP borrowings, but no new loans were available. The approximately $165 billion that banks had borrowed through the BTFP has now been repaid. The safety valve is closed. This is the smoking gun number 3. The banking system is now carrying approximately $364 billion in unrealized losses, reduced from the peak, but still historically elevated, without the explicit backstop facility that was created specifically to address that vulnerability. The problem was not solved. The emergency room was closed, and patients were sent home to manage their conditions with existing medication. Here is the contrarian perspective that almost no mainstream financial outlet is stating with sufficient clarity. The consensus view is that the regional banking stress of 2023 was a contained event, that the large banks are well capitalized and not at risk, and that the remaining unrealized losses are a manageable accounting issue rather than an operational threat. That view may well prove correct. I want to be clear about that. But it rests on two assumptions that are worth examining carefully. The first assumption is that depositor behavior remains stable, that no significant new confidence fracture occurs that triggers accelerated deposit outflows from stressed institutions. In a world of mobile banking apps, social media, and group chats, this assumption is harder to hold with confidence than it was before March 2023. The second assumption is that Treasury yields do not sustain materially above current levels for extended periods. If yields rise to 5.5 or 6%, driven by the fiscal deterioration I described in the previous video, or by continued foreign selling of treasuries, the unrealized loss position worsens significantly, and the Tier 1 capital pressure intensifies at multiple institutions simultaneously. Neither of those assumptions is unreasonable, but neither is certain, and the consequences of being wrong are asymmetric. The downside of a confidence fracture in the banking system is substantially larger than the downside of being overly cautious with your deposits. Let me address three specific objections directly. Objection 1, my deposits are insured by the FDIC. I have nothing to worry about. I can hear you thinking, the government insures my deposits up to $250,000. So even if my bank has problems, I'm protected. For the vast majority of retail depositors, this is accurate and reassuring, and I do not want to undermine it irresponsibly. But here is the specific, important nuance. FDIC insurance is backed by the Deposit Insurance Fund. As of early 2025, that fund holds approximately $125 billion. U.S. commercial banks hold approximately $18 trillion in total deposits. If a single large institution, a systematically important bank, experienced a confidence fracture and required FDIC support, the fund would need to be replenished through emergency assessments on other banks, or through Treasury borrowing, or through Federal Reserve support. All of those options are available. None of them are instant. The protection is real, but it requires time and process to deploy at scale. In a digital bank run that moves $42 billion in a single day, as happened at SVB, time and process are exactly what you do not have. Understanding this is not cause for panic. It is cause for making sure you know what your bank holds, what your deposit concentration looks like, and whether you have taken basic steps to ensure your deposits fall clearly within insured limits. Objection 2, the big banks are fine. This is a regional bank problem. I can hear the next objection. JP Morgan, Bank of America, Goldman Sachs, these are too well capitalized and too well regulated to face this kind of pressure. You are conflating small regional banks with the major institutions. There is real merit to this argument. The 8 U.S. globally systemically important banks are subject to more rigorous stress testing, higher capital requirements, and more intense regulatory scrutiny than regional banks. But here is the specific counterexample that complicates the clean separation. The large banks are also the primary counterparties in the repo market, the interbank lending market, and the derivatives market. When a regional bank faces a liquidity problem today, its first call is to the interbank market, where a major bank is on the other side of the transaction. The large bank's safety relative to regional banks does not isolate them from regional bank stress. It makes them the transmission mechanism through which regional stress reaches the broader system. The large banks are the pipes. Regional bank problems are the pressure in those pipes. Continental Illinois was not a tiny institution. It was the 7th largest bank in America. Objection 3. The Federal Reserve will just intervene again. They always do. This is the most common objection, and it contains an important truth alongside a dangerous assumption. The truth? The Federal Reserve has demonstrated repeatedly that it will intervene aggressively in banking stress situations. The 2008 bailouts, the 2019 repo operations, the 2023 BTFP. The track record is clear. The dangerous assumption that the ability and willingness to intervene is unlimited and instantaneous. In 2023, the BTFP was created in 72 hours. That was possible because the problem was concentrated, the mechanism was straightforward, and the political environment permitted rapid action. A systemic stress event affecting multiple large institutions simultaneously, occurring against a backdrop of elevated political conflict between Congress and the executive branch over fiscal policy, in an environment of already elevated public distrust of financial institutions. That is a more complicated intervention environment than 2023. The cavalry will likely arrive. The question is always how much damage happens before it does. Here's the entire situation in one sentence. U.S. banks are carrying hundreds of billions of dollars in unrealized bond losses. A structural vulnerability created by the rate shock of 2022 and 2023, partially masked by a now expired Fed backstop. In an environment where depositor behavior is more mobile than at any point in banking history, Treasury yields remain elevated above the documented stress threshold, and the institutional safety net has fewer layers than it did 2 years ago. That is the situation. It is documented. It is public. Most people simply have not connected the pieces. Here is what you actually do. Action 1. Know your deposit insurance position. This week, if you have deposits at any U.S. bank, know whether they are within the insured limit of $250,000 per depositor per institution. If your business or personal accounts exceed that level at a single institution, understand that the excess is technically uninsured. This is not complicated. It is a basic accounting exercise that takes 30 minutes. Do it before the end of this week. Action 2. Review your bank's financial health. Before end of July 2025. Every publicly traded U.S. bank files quarterly financial reports that include disclosure of unrealized losses on securities portfolios. This number is found in the notes to the financial statements. Look up your bank's most recent 10Q filing. Find the section on available for sale and held to maturity securities. Look at the unrealized gain or loss column. You do not need to be a financial analyst to understand whether the number is large relative to the bank's stated equity. If the unrealized loss exceeds 20 or 25% of the bank's total equity, that is worth knowing. Action 3. Understand the money market option. Government money market funds, specifically those that hold exclusively U.S. Treasury securities, sometimes called Treasury money market funds, currently pay yields in the range of 4 to 5%, while offering same-day liquidity and carrying no exposure to bank balance sheet risk. They are not bank accounts. They are not FDIC insured. But they hold direct obligations of the U.S. government rather than claims on a bank's balance sheet. For cash that exceeds insured deposit limits, they are worth understanding. Between now and September 2025, spend 2 hours researching Treasury money market funds through your brokerage account or retirement account platform. Understand the mechanics before you need to make a decision quickly. Action 4. Watch 3 specific numbers through the rest of 2025. Number 1, the 10-year Treasury yield. If it moves above 5.25% and holds there for more than 2 weeks, the unrealized loss dynamic in bank portfolios is deteriorating materially. Number 2, the overnight repo rate. If it spikes above the Federal Reserve's target rate by more than 50 basis points, similar to September 2019, that is a signal of acute interbank stress. Number 3, money market fund flows. Weekly data is published by the Investment Company Institute. If total money market fund assets increase by more than $100 billion in a single week, that signals significant depositor movement away from banks. You do not need to monitor these daily. Check them weekly. They will give you more useful early warning information than any financial media commentary. Action 5. Do not mistake stability for safety. The most psychologically difficult aspect of the situation I have described today is that everything currently looks calm. Banks are open, ATMs are working, your balance shows the correct number, the system is functioning. This is always true right up until the moment it is not. Continental Illinois looked fine on May 1st, 1984. Silicon Valley Bank passed its stress test. The repo market was orderly on September 16th, 2019. Stability is not safety. Stability is the state the system is in before the conditions that have been building, quietly, structurally, measurably, reach the point where they cannot be contained by the normal operations of the institutions responsible for containing them. Understanding the difference between those two things is the most valuable thing I can give. And I'm going to show you what the Basel III Endgame capital rules, which the largest banks have been lobbying aggressively to water down, would actually require them to do if implemented in their original form. And why the battle over those rules in Washington in 2025 is one of the most consequential financial policy debates you have never heard of. Subscribe. Turn on notifications. Because the information advantage of understanding what is in those disclosures before the next stress event is the only edge that is freely available to anyone willing to read the footnotes. I will leave you with something the economist Hyman Minsky spent his career trying to explain, a concept so important that it was almost completely ignored until 2008, and even then was understood by far fewer people than it should have been. He said that stability itself breeds instability, that the longer a financial system operates without a crisis, the more risk accumulates within it, because participants gradually stop pricing in the risks they have stopped experiencing. The last U.S. banking crisis serious enough to require systemic intervention was 2008, 17 years ago. 17 years of stability. Think carefully about what Minsky would say about that.